Yeah. So tokenization at the end of the day is the creation of a digital proof of ownership in an asset. We typically look at it from the perspective of financial assets such as bonds, equities, fund shares. And so these are assets, that have already existed for hundreds of years. And typically the proof of ownership in these assets was done through a piece of paper, through a paper certificate. Now, tokenization allows you to create a digital proof of ownership, and it can replace the paper. So what formerly was paper now is a digital token. Sometimes a token is just a digital twin of a real-world physical asset, such as real estate or a vintage car or art or a gemstone. So there's plenty of use cases. Again, we typically come from the institutional side of financial assets, but beyond that, you have digital twins in the form of tokens, and then also you have utility tokens, you have NFTs, and all of those, in some way or the other, are simply a digital asset and a digital representation of value. Tokenization always happens on a blockchain. So you would take an existing blockchain, and different blockchains have different methods how tokens are created. On Ethereum and Ethereum compatible blockchains, or EVM chains as you might call them, EVM stands for Ethereum Virtual Machine, you need something that is called a smart contract in order to deploy a digital token. So this is a method that is specific to the type of protocol that runs under Ethereum and EVM compatible chains. There's other blockchains such as Stellar, for example, which is also frequently used in the context of tokenization, where when you create a token, you essentially send a transaction. There's a certain method, a technical method, how these tokens are created. And then you need to make a link to the asset that these tokens actually represent. And there's also several ways to do that. When you have a security, then you would have a securities prospectus. The securities prospectus might include the issuer account, which is essentially the address from which you have created the token, in order to make sure that when you hold a token, you actually know you have the right token that represents the assets that you want to hold. There's several other ways. In gemstones, for example, you have a certain method of tagging. So in a diamond, for example, you would have a little engraving that you cannot see with your naked eye. You need a microscope. And there you have something like a reference code, and that could reference the token. So there's several ways how to actually make sure that there is a link between the digital asset, which is the token, and the actual real-life asset, which can be a prospectus, a physical property, or other assets at the end of the day. The motivations for financial institutions to look into tokenization and to start tokenizing vary. In Germany and Western European countries, a lot of it is actually driven by efficiency and efficiency gains. There are estimates that when you create tokenized securities versus traditional securities that are centrally deposited with a CSD, such as Clearstream or Euroclear, then the total origination and issuance and settlement process, you can save around about 50% of the cost, which is quite substantial, especially when you look at large transactions in the hundreds of millions and even billions of dollars. And then even a saving of 5 to 10 basis points can be really substantial when you talk about absolute money terms. Cost is also time to market. When you register a new security and as a bank, as a smaller bank, for example, you don't have a direct account with the CSD, with Clearstream, for example, then between issuing the actual security and having it registered with the CSD, it can easily be 5 or 6 weeks. If you tokenize, with a click of a button, the security is created and settled. You will also find revenue-related aspects. And that is often the situation where you would like to attract new investor groups that you were not able to attract with your conventional centrally deposited assets. Why is that? It's mostly driven by the denominations. If you look at the bond market, for example, it's primarily driven by institutional investors. The denominations are 100,000 euros per bond or above. And of course, this is not accessible to retail investors. If you want to make that more accessible to maybe high net worth or even retail investors, then you would need to lower the denominations from around about 100,000 euros or dollars down to maybe 10,000, 1,000, even just 10 euros. And this is something that is only really feasible and only cost effective if you have a tool such as tokenization at hand, where the efficiency is much, much bigger and where you have more parts of the value chain of the process under your control. And therefore, some banks look into tokenization because they want to make certain assets accessible to a broader investor base. There's plenty of motivations, but there's one camp which you could call the efficiency camp, and the other camp is more the revenue generating camp. Just last year, Germany passed the so-called Electronic Securities Act, which now make it possible to tokenize bearer bonds, which previously was not possible because bearer bonds under German law needed a physical paper certificate, and so you could not replace it with a token. With the Electronic Securities Act, this is now possible. So in Germany, for example, we see a lot of use cases that are rather in the bond area. Of course, a bond can represent many things. It doesn't have to be just your corporate bond, where a corporate goes to the capital markets and needs to raise 100, 500 million euros in capital. But there's also different structures that can utilize the legal umbrella of a bond, but can represent real estate, can represent a portfolio of art, can represent a portfolio of vintage cars. So a bond doesn't necessarily have to mean that it's a straightforward corporate bond, but the bond can be used as a structure for other assets. And in fact, we do see most of the use cases so far coming from the area of bonds, not just in Germany, but also in other countries. One of them is custody. If you want to deal with tokens, you need to have a way to safekeep them, right? And retail investors might be able to do that in their browser wallet, such as MetaMask or something similar. They install a browser plugin, they have an address, and all of a sudden they can own tokens. This is fine for a retail use case. This is comparable to the cash that we carry in our wallet, for example, right? But we wouldn't carry our life savings in our wallet. We typically have them deposited with a bank. And banks, of course, have high regulatory standards, have extremely high standards in terms of security. And so you need to have a good custody solution. The other hurdles that you see, especially when you look at tokenization from an institutional standpoint, is of course technological transformation in general. Those of you who may have seen how long it takes a bank to replace its core banking system, for example, or even to replace something more straightforward, such as a CRM system, these processes typically take several months, sometimes even several years. And the same is true for switching your settlement technology in the area of bonds, in the area of equities. You need to have the technological components in place, custody, tokenization, AML tools, and a few other parts. But of course, you can't just go out and go to the best vendors, such as Fireblocks and Bitbond, and say, well, from tomorrow on, I want to use your software. You need to implement that. And that implementation is often a much bigger hurdle than selecting the right vendors and finding the right technologies. I did not mention it in the list of hurdles or barriers that are there right now, but secondary market is one of the, I would say, more open topics. As I said, custody technologies there, tokenization technologies there. In certain areas, we already have a very favorable regulatory environment. Secondary markets is something tricky. On the one hand, we have plenty of, fortunately today, very well-functioning and secure cryptocurrency exchanges. Coinbase, Kraken, Bitstamp, many others that are providing a very reliable and secure service with high liquidity, low latency, everything that you would expect even as an institutional investor. However, they only list cryptocurrencies for trading right now. There is no security tokens, no tokenized securities that they are listing. And what prevents them is the regulation to the most part. The so-called CSDR, the Central Securities Depository Regulation, currently, at least in Europe, still requires exchanges to only list such securities that are centrally deposited with a CSD, such as Clearstream or Euroclear. Which means that effectively right now they cannot list tokenized securities. There's first steps to change that with the pilot regime that has been issued by the European Commission, and there will be certain exemptions, and first exchanges such as the Luxembourg Stock Exchange are going to utilize those exemptions, but we're certainly in the very early days when it comes to regulated secondary trading. What we have today is we have OTC trading, of course, that's going on, and what we also have are decentralized exchanges. However, decentralized exchanges for many issuers are tricky to use from a regulatory standpoint. I think where we need to get to is we need to have a regulatory environment that allows tokenized securities to be listed on regulated securities exchanges without being centrally deposited. And this is something that's probably going to take easily another 2 to 3 years until we are there.